Chapter 1, Generalities. Managerial or administrative accounting, often referred to as management accounting, is a branch of accounting that focuses on providing internal information and data to help organizations make informed business decisions and manage their operation effectively. Unlike financial accounting, which is primarily concerned with reporting financial information to external stakeholders, managerial accounting is primarily aimed at aiding manager and executive within the organization in planning and controlling and decision making. Key characteristics and concept of managerial accounting include cost analysis, budgeting and forecasting, performance measurement, decision support, CVP, cost volume profit analysis, variance analysis, internal reporting, summary managerial or administrative accounting is crucial for helping organizations make informed decisions, control costs, and improve overall operations efficiency. It plays a pivotal role in managing the internal financial aspect of a business to achieve its strategic goals. And financial accounting and managerial administrative accounting are two distinct branches of accounting that serve different purposes within an organization. Here's analysis of the key difference between them. Purpose: financial accounting, managerial accounting, and the users is financial accounting, managerial accounting, and reporting time framing is financial accounting and managerial accounting. And regulatory standard is financial accounting, GAAP, and the reporting standards, EIFRS, managerial accounting and natural informations. This is the same and scope. Financial accounting and it covers two entire organizations and aims to provide comprehensive view of the company's financial position and performance. In summary, financial accounting is focuses on providing external stakeholders with a snapshot of a company financial health and compliance with accounting standards, while manager accounting is aimed at helping internal management make informed decisions, control costs, and improve the organization operational efficiency. The difference is in purpose, user reporting time frame, and the naturalness of information highlight the distinctions between these two accounting based branch. And management accounting plays a crucial role in the administrative process of organization by providing valuable financial and non-financial information that helps managers and executives make informed decisions and effectively administer her organization. Here are some key roles that management accounting plays in the administrative process. Planning, decision support, and performance measurement is in KPIs, cost analysis, variance analysis, strategic planning, resource allocation, internal report, and continuous improvement, compliance. In summary, management accounting is an integral part of the administrative Processing organization is provides the financial and operational data necessary for planning, decision making, performance measurement, and overall management on resources by facilitating an informed and strategic decision making management accounting enables the effectiveness and efficiency of administrative functions within the organization. Chapter 2, Cost Classifications. And cost classification based on capacity criteria involves categorizing costs according to their behavior in relation to productions or sales volumes. This classification helps organizations understand how costs change as their level of activity or output change. The key capacity criteria for cost classification include fixed costs and capacity related fixed costs. An example including annual rent for facilities and salaries or permanent staff. State variable cost, and the under variable cost is directed variable cost and indirect variable cost, and mixed cost is semi-variable cost. Is this cost have both fixed on variable components. Step cost, capacity cost, and ile capacity cost over her cost, and the understanding cost classification based on capacity criteria is valuable for cost control, budgeting, and decision making. It helps organization allocate resources more efficiently, plan for change in activity levels, and identify opportunities to reduce costs on or increase production efficiency. The choice and appropriate activity basic for cost allocation depends of the type of components it processes and the natural of its products of service. And different bases of activity can be used and the suitability of a particular basis vary from one situation to another. Here are some common bases of activity and their suitability for different types of companies, process, and product. Labor hours or labor costs is suitable for labor intensive business where employment and is a significant driver of cost. Um, Such as service-based companies, custom manufacturing, or project-based organization. Mm, to machine hours or machine costs, suitable for directing material uses, suitable for a number of units produced is suitable for a number of orders of machining processes, square footage or for floor place space, a number of customer services and miles driving or vehicle usage, number of service hours, um, energy cons- consumptions, a number of septums or changeovers and sales renewal, number of inspection or quality checks, and number of process staff or workstations. The appropriate choice of an activity basis depends on the specific cost allocation, objectives, and the factors that drive costs in a particular organization. Is essential to carefully assess the natural of the business and the activity that most significantly influence costs to select the most relevant and accuracy activity base for cost allocation. Certain codes can be classified into various categories based on their natural and how they relate to a company operations. Here's a classification of a cost into their respective categories. By behavior, fixed cost, variable cost, semi-variable cost. By functions, cost of goods sold is COGS, and manufacturing operation expenses. So by controllable costs, non controllable costs. By traceability, direct costs and indirect costs. By time historical costs, predetermined costs. And by volume, full capacity cost, utilities capacity cost. By product or period is product cost, period cost. And by functional naturals, manufacturing cost, non-manufacturing cost. By customer or job and project cost. Batch or process cost. And by location or department, cost by department or cost by location. These are general classification, and in practice, codes may be further broken down or categorized differently based on a company's specific needs and accounting practice. And decomposition, mixing costs into their fixed and variable part is a common financial analysis technique that helps organizations understand how these costs behave and can be managed. To decompose mixes costs, you can use 18-day high-low method of the SK graph method, or how to do it. Um, and keep and mind and discard scattergraph method is a visual estimation and might not be as precise as the high low method, but it can still provide a reasonable approximation of fixed and variable costs. Once you have decomposed the mixed costs into their fixed and variable parts, you can use this information for various purposes, such as budgeting, pricing decision, cost control, and financial analysis. That this allow can be understanding of a cost behavior and support more accurate financial planning and decision making. And chapter 3, variable costing and total costing. Variable costing and absorption costing, total costing, are two different approaches to assigning and allocating cost to product or service. They primarily differ in how they treat fixed manufacturing overhead costs. Here's a difference between the two costing systems. Variable costing. Um, on machine cost to remove, fluctuating net income, and management decision making, variable and fixed cost, machine cost to remove, stable net income, tax and external reporting. The key difference between variable costing and absorbing costing is the treatment of fixed manufacturing overhead costs. Variable costing expenses fixed manufacturing overhead as incurred, which can lead to fluctuating the net income. Absorption costing, and the other hand, treat fixed manufacturing overhead as a cost of production and measures and manufacturing cost to remove, resulting in more stable net income figures. And the choice between these two costing methods can have significant implications for financial reporting, internal decision making, and tax calculations. Variable costing and absorption costing, total costing each have their own relationally and are used in different contexts. based of the objectives or financial reporting, cost control, and decision making. Here an explanation on the national rationale for each costing method. Rationally for variable costing is a matching cost to remove, simplification for international decision making. CBP is the gain, cost volume profit analysis. Um, Understanding cost behavior, compliance with accounting standing is GAAP. On stable need income tax reporting is the variable costing is often referred for internal decision making cost analysis and management reporting because it allows for a clear understanding of cost behavior and its relationship to production and sale levels. Absorption costing, on the other hand, is generally used for external financial reporting as it complies with accounting regulations and present a more conservative view of income by matching and manufacturing cost to remove. The choice between this costing method depends of the specific needs of an organization and the reporting requirement is moved at here too. And the other is variable costing plays a crucial role in various aspects of the planning process, administrative control, performance evaluations, and decision making with an organization. Here's how variable costing concept can be applied is in each of these areas: planning process, CBP, scenarios analysis, administrative control, performance evaluation, decision making. Mm, is all, and the difference in result obtained under variable costing and absorption costing method, total costing methods primarily stem from how fixed manufacturing overhead costs are treated. It's important to understand the logic and justification behind this difference. Variable costing results, direct cost allocation, yes, income is statement, inventory valuation. um, Income is statement, inventory valuation, and the key is to understand the rationale behind each method and use to one that aligns with the specific reporting and decision making on the organization. And the concept of contribution margin is a valuable tool in decision making process, particularly in assessing the financial impact of different choice and alternatives. Contribution margin represent the amount of revenue remain after covering variable costs and is used to analysis to provide the product, service, or business segment. Here and how contribution margin can be applied in decision making. Chapter 4: Relation Cost Volume Profit. Um, the term balance point can have different meaning depending on the context in which it is used. Here are a couple of common interpretations. That's break-even point (BEP) on equilibrium of center of mass. This is specific meaning of the term balance of point might vary depending on the job's subject matter of or context in which it is used. The CBP or the cost billing profile relationship is a valuable financial analysis tool used to understand the interaction between cost, volume of production or sales, and profits in a business. While CBP analysis provides useful insight, it also has its limitation. Let's explore the use and limitation of the cost volume profile relationship. Use of CBP analysis, break even analysis provide planning, cost control, investment decisions, scenario analysis, implicit assumptions, assumed linear relationship, limited, limited, limited to show their term decisions, neglect non-monetary factors and single product focus. In summary, while CBP analysis is a valuable tool for understanding cause and profile relationship, it is essential to recognize its limitation and use in a conjunction with other financial and strategic analysis for comprehensive decision making. CBP analysis is most effective when applied to well defined short term decisions in scenarios where it simplifying assumptions alike with the actual business environment. Cost volume profile CBP analysis, also known as break-even analysis, is a financial modeling technique used to examine the relationship between cost, sales volume, and profit within a business. This analysis is based on several key assumptions that help simplify and make the analysis manageable. The assumptions underlying CBP analysis include constant sales price, constant variable cost, constant fixed cost, single product or uniform sales mix, short-term analysis, constant efficiency, constant renew, no inventory fluctuations, no income tax considerations. It's essential to recognize the assumption when using CBP analysis, while tips assumptions simplify the analysis and making it more manageable. They also mean that CBP results and are approximations. Um, the safety margin, other referred to as the margin of safety, is a financial and risk management concept that represents two exit of actual or experience set over the break-even point. In other words, is the difference between current and a project sales and the level of sales at which a business neither makes a profit nor incurs a loss. The safety margins provide a cushion or buffer against unexpected variations or downturns in sales. On the finally, cause volume profile, the CBP analysis in a valuable tool for planning to decision making in a business. Here are some pieces of advice for effectively using the CBP relationship in your planning and decision making process, and understand the assumptions, determine a relevant range, calculate break even point, analysis, contribution margins, sensitivity analysis, scenarios planning, pricing strategy, decision making on multiple product lines, risk assessment, collaborations. By following these guidelines, you can effectively use CBP analysis to support planning and decision making in your business, enabling you to making informed choice, the optimize profitability, and manage risk. And finally, certainly let us continue to discuss cost concept in more detail. Explicit costs, these are tangible out of pocket expenses incurred in running a business. Example include salaries, rent, utilities, and the cost of raw materials. Implicit costs, they represent the opportunity cost of using resources in a particular way. They are not directly visible in the accounting records, but they reflect to the value of resources that could have been used elsewhere. For example, the loss of income from using Um, Saving to start a business is implicit cost. Direct cost is are expenses that can be directly attributed to a specific product, project, or department. For example, the cost of material used to make a product is a direct cost. An indirect cost, also known as overhead cost, cannot be directly attributed to a specific product or project. Example include rent, utilities, and administrative salaries. Variable cost is where cost change in indirect proportions to change in productions. As production increases, variable cost increases, and uh, vice versa. Raw materials and direct labor are common examples of variable costs. Um, Fixed costs remain constant regardless of the level of production. They include expensive such as rent, insurance, and administrative salaries. Total cost. This is the sum of fixed and variable cost.